So for that, people just were guffawing and said, aha, Oren Cass admits he literally doesn't know the first thing about international trade. How can you not know, Oren, that comparative advantage is the essence of international trade analysis, and that's where trade deficits come from? Okay, and so anyway, I knew that you obviously knew what they meant and that you were asking something more subtle. So why don't I just stop there and then give you an opportunity to explain that, your IQ is above 60. You have studied this stuff. So can you elaborate on what did you mean when you said, why would comparative advantage determine trade deficits?
Yeah, I think it's a really interesting question. And one thing I wonder is, I don't know how much of the confusion I created was because I ellipsed out all of the other things they listed.
Welcome to InFi, the future of finance.
Hey everybody, welcome back to InFi. Today I'm going to be speaking with Oren Cass, who is the founder and chief economist of American Compass. And he's editor of the forthcoming The New Conservatives, Restoring America's Commitment to Family, Community, and Industry, which is coming out in June of 2025. His previous book, the 2018 The Once and Future Worker, A Vision for the Renewal of Work in America, has been called absolutely brilliant by the New York Times columnist David Brooks, and Vice President J.D. Vance said of it, a brilliant book and among the most important I've ever read. To give a little bit of his background, from 2005 to 2015, Oren worked as a management consultant in Bain & Company's Boston and Delhi offices. He got his J.D. magna cum laude from Harvard Law School. And I have known him. He had been at the Manhattan Institute as a senior fellow, and he was heavily involved in the carbon tax debate. And that's how my path and Oren's crossed several years ago. And we alluded to that a little bit in the beginning of this discussion you're about to hear. But big picture, Oren is a general fan of the free market, but he has been skeptical of free trade, or at least the way it's been justified and promoted by right-of-center economists. And that's what we're talking about in this discussion. I'm not here to debate him. That's usually not the style unless we both agree ahead of time that that's what we want to do for a podcast episode. But rather, the point here is I disagree with Oren's conclusions on a lot of this stuff, and he knows that. But we both want the public to really understand the argument. So we're trying in this discussion here just to tease out the implications. And I ask him a bunch of clarifying questions just so I understand, how is it, Oren, that you and I have similar premises and we agree on so much other stuff? Why is it that we disagree so much when it comes to free trade? So that's the point of this conversation. I think you guys are going to like it. Without further ado, here is my conversation with Oren Cass. Oren, welcome to the InFi podcast.
Thank you for having me. It's great to see you.
Nice seeing you again. So can you just I would have already put in some of your biographical details in the intro here, but just for people listening, can you just give a brief sketch of, among other things, you and I used to be good buddies. We were attacking those people trying to impose a carbon tax, and I was going around, and then also Tom Woods and I had you on our Contra Krugman podcast.
That's right.
When the Democrat, their talking point was something about the states that phased in Medicare or something, and how...
Yeah, that's right. It was the Medicaid, how many lives Medicaid saved, I think was the question.
Yeah, and you just went right into the details and showed that, no, actually, it's the exact opposite of what they're telling people. And so you're a skeptic of people proposing bigger government, and that's how I do it, and you were very good with the numbers and with the carbon tax stuff. It was like you and I were the rival, that I would be at a conference presenting my stuff, and other people were talking about you in the hall, and I was like, oh, who's this guy? Everyone's talking about him and not me. So anyway... That's all to say, it's just interesting now that I find myself that a lot of my colleagues are going around constantly telling people how you don't know the first thing about economics and so forth. So maybe can you just give a little bit of background of how do you find yourself in this situation where you used to be buddies with a lot of the free market camp and now they can't stand you?
Well, I was going to say, at least we're still friends. So that's the important thing. I think it's been very interesting to see, as you said, that I think there are a lot of issues where I still see very much eye to eye with a lot of traditional right-of-center free market folks. But a place where I was always concerned, going all the way back to, I worked for Mitt Romney's presidential campaign in 2012. Then I started doing my other policy work, was on globalization and trade. It seemed to me that is a place where sort of very good, passionate support for free markets has drifted into what I would characterize, and I know people don't appreciate it, but I think it is a somewhat accurate description of the thinking as a market fundamentalism. And I wrote once about kind of why I think the term is actually useful. In the religious context, fundamentalism isn't like a derogatory term. It
Right.
describes a certain type of thinking or ideology that, in a sense, tends to misinterpret or repurpose original texts in an effort to impose a much more rigid and absolutist outlook. And I think that is what we have seen in the trade context, where, I think the things that Adam Smith wrote about why trade can be good were exactly right. I think Ricardo's description of comparative advantage was incredibly important. But then somewhere along the way, we got to the year 2000 where people were saying, well, therefore, free trade with the authoritarian communist regime in China is a great idea. And the more cheap stuff people want to send us, the better. And if you don't understand that, you don't understand economics. And I was just sort of sitting here saying, no, I understand exactly what you're saying, but that's not good economics at all. And I think it's been very encouraging in really just the last few years, we've started to see more mainstream folks coming around on this. I mean, Janet Yellen had a very interesting comment last year where she said, look, the sort of standard economics tells you if people want to send you cheap stuff, just say thank you. I would never say thank you again. I was actually doing a conversation with Paul Krugman where we were discussing his assertion that trade deficits are self-correcting, which he'd made back in the 90s. And, he acknowledged that was naive. And so I think we are moving toward a very useful rethinking and breaking out of the fundamentalism. But to your point, there are certainly many folks, not all, but predominantly on the right of center, who are still just sticking to, if you don't understand how great free trade always is, it must be because you don't understand Econ 101.
Right. And it's also interesting, too, that I won't name names, but there was a guy, someone who's not your biggest fan among my colleagues, that in addition to, saying you obviously haven't studied economics or you need to, crack David Ricardo or something, he was also lambasting and saying all the public intellectuals in support of Trump's tariffs have never even taken an economics course. And so someone just asked Grok, and two of the four, so you were one of them and you actually have taken an economics course, but also two of the other ones had PhDs in economics from Harvard. It was, Peter Navarro and, the Council of Economic Advisors.
Stephen Moran.
Yeah. And then anyway, and the guy, of course, moved the goalposts. So, they're political appointees. They're not public intellectual. Okay, fine. But anyway, my point is just, and what I've been telling my colleagues, so this, folks can gather, I actually do largely disagree with your conclusions on this stuff. But my point is, well, there's a whole lot of people, like people telling me that they were longtime fans of my work, who think you libertarian ideologues or dogmatists are getting this stuff wrong and you're just got your heads this. So even if I think you guys are wrong, like just to say, oh, no, we're smarter than they are. They must not know anything because, hey, comparative advantage, like that's not going to work anymore. So anyway, that's partly why I have you here. So why don't we jump in, Oren? You recently shared and the folks watching the video will see, we'll have they'll superimpose this stuff so you can see what we're talking about. But you had this very provocative tweet that showed some Fred, the St. Louis Federal Reserve charts. Then you say, your tweet says, may need a bot to tweet this picture daily. When you hear manufacturing job loss has been going on for 50 years, or it's mostly automation, or this was just the expected decline in manufacturing share of jobs, please remember the data. Many good debates to be had working from shared reality. And so you've got on this top pane, all employees manufacturing, and you've got this bright red line that you call U.S. grants China permanent normal trade relations that happens, was it like December of 2001 is when that kicked in, I believe? Yep. And you're kind of doing it before and after, and the top pane's looking just at total employees in manufacturing. And then the bottom pane is the industrial production manufacturing index as they compile it in the national accounts. And so the manufacturing jobs, to the left of the red line, it bounces around, but you say manufacturing jobs steady, and then, yep, it does drop precipitously to the right of that red line. And you say manufacturing jobs plunge. And then on the bottom pane, you say manufacturing output grows. And then to the right of the red line, you're saying it's flat. So before I, start trying to poke holes in this or to get our arms wrapped around it, possible shortcomings of your presentation here, let me just stop and let you comment on it. So again, the viewers now are looking at this tweet. So any commentary you want to give beyond what I've just said?
I would just sort of add the context that the reason we sort of found ourselves in this fight, I think in sort of outside of wonky economic debates, there's a widespread understanding that, manufacturing was very badly hurt by China's entry into the WTO and rapid offshoring to China. And that more broadly, the globalization, in a sense, going all the way back to NAFTA in the mid-90s, has sort of caused a phase change in the behavior of the American economy. And to my point, at the end of the tweet, we can have a great debate about whether that's a good thing or a bad thing, whether it's worth it or not. But it does seem to me a fairly uncontroversial reality. And what I've seen as kind of the pushback on that is an argument that, well, if you look at manufacturing employment as a share of total employment, that had been declining for a long time. And that's absolutely true. And that would be expected in any sort of developed economy as it grows and becomes more service oriented.
And in fact, why don't we, folks, we'll go ahead and just flash that right now so you can see what Oren's talking about. So again, this chart now is showing is a share of, I think it's the civilian labor force was the number I picked for the denominator. And so you can see that is a gentle but steady decline going way back. It's not that it falls off a cliff in 2001. All right. So that's okay.
And it is extremely frustrating to me when I see people use this as a sort of counter argument to those other charts, because we should be able to hold these things in our head at the same time. It is possible to have an economy where employment is declining manufacturing employment is declining as a share of the total, but also we're maintaining a steady number of manufacturing jobs. We're seeing manufacturing output rise steadily. That is exactly the formula for prosperity and a healthy growing economy. And you can also have a situation where manufacturing employment is declining as a share of total employment. But because of something like the way we approach globalization, you see manufacturing employment fall off a cliff in absolute terms. You see manufacturing output flatline. You see manufacturing productivity then start to stall. And those things aren't good. And so it seems to me that a useful conversation about what has happened in the economy recognizes that both of these things are true. That, well, the fact that the share declines is not some rebuttal of the fact that something went very wrong with globalization. And again, I think it speaks to sort of that fundamentalism to think, saying, well, look, the share was declining in the past and it's declining now, is somehow a rebuttal of the reality of what has actually happened to the American economy.
Okay, so let me just give some more context to that. So you're right, Oren, that, and I've said this too, that just in the abstract, without looking at the particular numbers, if somebody's saying, hey, I'm worried because manufacturing employment is falling, and certainly manufacturing employment as a share of total employment is falling over time, a standard free market response is to say, oh, well, guess what? Agriculture employment was a big sector of the economy back in 1880, and has steadily declined up through, the heyday of the 50s and 60s. But that doesn't mean we were in trouble. That's a sign of progress, that the U.S. was moving away from an agricultural-based economy to a manufacturing powerhouse. And still, we had more food production in 1950 than we had in 1890. It's because the farmers aided with, more capital equipment and so forth and better fertilizer, blah, blah, blah. A given worker could produce way more food in 1950 than in 1880. And that's how it works. And then the argument goes, and it's the same thing with manufacturing. If you look at measures of total stuff produced by the U.S., manufacturing defined, then those indices kept rising steadily, even as manufacturing employment dropped. So it's the same thing. And now we're switching away from making TVs and cars and making, software and things like that and financial services. So that's exactly what you'd want to have happen. And so I just kind of refresh. So again, just make sure people are getting lost. So your response is what to say, well, okay, yeah, but if you look at the absolute number, like you have on your top chart there, no, something clearly is going on with the absolute number of people employed in manufacturing. This is not just some steady decline because productivity keeps going up year by year.
And I would add one other point, which is an important distinction from agriculture, which is that at least to a first approximation, there is a flatlining in the number of calories that people consume. Obviously, to some extent, that's not entirely
not
the
in my case.
Yeah. Hey, perhaps not to the good, but what we have seen is that to the extent that agricultural employment, really falls off as a share of the economy, that's because there is, again, adjusted for population, so much food that you want to grow, and you can keep doing that with less and less people. The picture with manufacturing is actually very different because as we become richer, yes, we consume a lot more services. We also consume a lot more goods. And you can see this even as a snapshot if you compare the consumption of someone near the top of the income distribution to somebody in the middle. The difference in what they're consuming isn't just software and yoga lessons, right? It's lots more stuff. And where the rubber meets the road on this is in this other thing that everybody's now fighting about, which is the trade deficit. If we had seen this happen in manufacturing because, well, that's how much stuff people want to consume. This is just a healthy market response. I think you'd want to think about how to help people maybe who were left behind as a result, but you certainly wouldn't try to reverse that. But what we see is this massive rising trade deficit up to the point where we're now importing $1 trillion a year more in goods. Even including services, we're importing $1 trillion more than we export. And so that's a huge blinking red light that says what has happened in manufacturing is not a result of changes in consumer demand, the things that people in the economy actually want. It is entirely a shift in who gets to make the stuff. It is a set of policy choices that we have made that has led the answer to be the stuff gets made elsewhere. And again, that's a starting point then for a great debate about whether that's okay or not, whether we should be concerned. But I don't understand why we would argue about that basic fact that has happened, and that is not a natural result of economic development. That is a result of policy choices.
Okay, great. And I think I would have said this in the intro, but I'll say it again here. My point, folks, with this, I'm not debating Oren. I just want to tease out and make sure I really understand the nuanced views he has. And then, I might write stuff in the future on it if I disagree. So just, that's an interesting little twist you put on that I've never heard someone say officially. So your point is the standard free market kind of response that I just gave about, oh yeah, this is progress, capitalism for the win, that you start with agriculture, we shifted into manufacturing powerhouse. And then as we matured, we shift over into information services and things like that. Digital output. And you were saying if the U.S. just was a self-contained thing, or if we just looked at planet Earth and we just charted a similar evolution, sure, that's fine. And yeah, as the consumers shifted, as their income grew, and you only need so many cars, and your houses are only going to get so big after a while, and gadgets, and then you start shifting over into this more movies and accounting services and whatever hedge fund activity, and that's a bigger and bigger share of the total output in the economy. Fine. But your point is, no, the mismatch, it's not that American households all of a sudden flatlined in how much manufacturing stuff they were consuming year by year. It's that for some reason over time, they shifted away from buying it from U.S. workers and they started buying it from foreign workers making it. So that's really the issue. It's not a fetish for manufacturing per se. It's that, no, the U.S. households are sourcing their manufactured goods more and more from abroad, and you think that's the thing that is concerning.
Yes, that's right. And the one other piece I think, and implicit in your comment, is there's also a rate of change question. Mm-hmm. Because I think, in general, when you see an economy developing, there's a very healthy and natural way in which change occurs at the rate that the society can process the change. And so, do you see over time, whether you're talking about in agriculture or when you're talking about in manufacturing, before the era of globalization, do you see shifts in allocations of resources in the economy? Absolutely. But in part, those are contingent on and responsive to the population, where people live, what jobs people can do. And so, yes, over time, maybe fewer people move into some industries, more people move into other industries, things move around. Absolutely. And that's entirely for the good. It is extraordinarily different. And we'll just add one more thing. And when you're automating and getting productivity growth, that again tends to be constrained in how fast you can even do it. You don't see very often sudden, oh my gosh, because of some new technology, millions of people are being laid off. What you see is gradually, as technologies are introduced, that changes the structure of the workforce. Again, that can be a very good thing. And that's entirely different from what we see in that chart that you put up of manufacturing employment, where you just say, okay, everybody, you can just go and produce in China instead of in the United States. And if that craters an entire sector of the American economy that is incredibly important in all sorts of ways, now we're kind of just shrugging and saying, oops. And that was a mistake in the past. And it is something I think we should be trying to address in reverse now.
Okay, great. We are going to get into the deep conceptual issues here in a bit, folks, but let me just focus again. So we'll flash up again your tweet here with the charts, the top and the bottom pane with this big red line. It occurs to me, Oren, maybe can you just take a minute and explain to people what what does it mean to say the U.S. grants China permanent normal trade relations? Like, what was the situation before and after, and why is that so? Why did that make it easier to outsource manufacturing jobs to China, for example, or to switch to imports if it's Chinese-run firms?
Yeah, sure. So the way that the World Trade Organization structure operates is that essentially every country that is a member agrees to grant what's called most favored nation status to every other member, meaning, whatever your best lowest tariff rate is, that's what everybody gets. And so if you look at, the United States has what's called its harmonized tariff schedule. And so it has one column for most favored nation, sort of extraordinarily low tariffs, pretty much an open market. And then it has another column for you're not most favored nation. And essentially the only countries there are like, North Korea and so forth. And so on a provisional basis, the United States for a number of years had started saying, we are going to give these same rates to China, but it's going to have to be renewed by Congress every year. And the debate was, should China actually be admitted into the WTO and get the same status that all the other countries get as these kind of permanent open trading partners? And so once that decision was made, essentially the legal and economic framework was established that you can invest and import from China just as well as you can from Canada or from Germany. And what you saw was then a very sharp increase and it wasn't only the US that faced this, but the US as a particularly large consumer market and with particularly low tariffs, very quickly saw multinational corporations say, oh, fantastic. Well, then here we go.
Right.
And I think the other thing that's important to emphasize, and this will kind of connects to the comparative advantage discussion as well, is that it's not just that, there's something magical about the Chinese soil that makes it a wonderful place to manufacture. It was the very aggressive, explicit policy of the Chinese Communist Party to subsidize production there and to suppress wages there, to make it the most attractive place to invest, to make it the place where you could earn the most profits. And so corporations who, under capitalism, are supposed to just go invest wherever they can get the highest return on investment, very quickly and in large numbers said, well, this is what we should be doing. Mm-hmm. And Americans were the beneficiary of very cheap stuff, but also faced the cost of the hollowing out of industry over the following decade.
Okay, great. And this might be unfair if you don't have it at your fingertips, that's no problem, but do you have a sense, like, in general, what the tariff rate was or other import barriers to Chinese goods as of like 1998 versus 2002? Like, to get a sense of...
No, it's a good question. I think as I said, for a number of years on a provisional year over year basis, China had already, the tariff rates on China had been lowered. What was different with their admission to the WTO was the permanent status was established.
Okay. So that might have just given more certainty to people setting up supply chains and stuff like, oh, then now we know this is how it's going to be, so we can go ahead.
Yes, exactly. And so I think you see the sort of much more rapid shifting in supply chains. I think conversely, there's a way to look at the data and see that some of this was already happening in the 1990s. And so, and I think conversely, you see some of it takes time then to happen as the 2000s proceed. So the red line on the chart marks a particularly important sort of pivot point. It's not the case that everything was one way before and everything was the other way afterward. But I think conversely, it would be very difficult to look at what happened and say, well, I don't think anything of particular note happened around 2000 or 2001.
Okay, great. Let me just take a few moments here, folks, too, because otherwise my economist colleagues are going to kick me out of the club. I do want to give a little bit of pushback here just on the numbers.
Yes.
To get people
no, please do. That's the interesting part of the discussion.
Yeah. So here we're flashing again, folks. Orange chart and that top pay. Let's focus on the top pay first. So this is the absolute employment level of, U.S. people in manufacturing. And you're showing, it's bouncing around there on the left side, but what you describe as manufacturing jobs steady and then clearly falls off. So I think one might get a different view if we pull up. So here, it's the same data, except it's a longer time frame. So it's starting back in, I think, 1939. And so if you're just looking at this and I don't give you any labels or something, I mean, the manufacturing employment peaks in the late 70s. And then it comes down, and it was clearly, rising up through the, it's bouncing around all the time. There's business cycles, but it looks pretty clear that it's, rising and then peaks in the late 70s, and then it has a downward fall. So I think it's a bit misleading to look at that and say, oh yeah, manufacturing output was steady before 2001. Are you okay with that, with my summary there?
You mean that manufacturing employment was steady before 2001?
Yeah. Is that what I said? Yeah, that's what I was trying to say, yeah.
Yeah, I think you see, if you pick kind of the late 1970s as the absolute peak, you see some modest decline from the late 1970s on. To your other point, it is somewhat obscured by business cycles going on therein. But again, in my mind, that connects very much to the earlier point about sort of what is the smooth, natural progression you would expect to see in a healthy economy versus what is the discontinuity that you cause through globalization. I don't think you can look at the trend and say, well, the 2000 and 2010 period is a natural continuation of what you saw going on earlier.
Yeah, let me try to be fair to both. So I think your chart, from your tweet, by not having that earlier stuff and say, it's basically, employment was kind of steady before someone might be more interested to say, oh, wait a minute, if you go back to you can see it was rising up over the decades and then gently. But I also agree with you, Oren. It's crazy that someone could show this chart and say, no, this is just, manufacturing shifting over into information technology services. And no, the WTO had nothing to do with it. Whatever you want to say, that clearly manufacturing employment in the U.S. falls off a cliff in 2001. And then the global financial crisis has another huge hit to it. So I do think people are being disingenuous if they try to act like the trade arrangements have nothing to do with it. Maybe they could say it's a good thing, that, we're getting manufactured goods at a cheaper, that's great. I mean, again, that doesn't mean it's good or bad, but to act like you're saying, let's at least have the same facts that we're talking about here, that clearly something happened rapidly there. Okay. And then real quickly, again, just to flash your tweet up here, look at this bottom pane about the manufacturing output grows. And so here you're showing, you make it look like, oh, it's growing. And then all of a sudden it's flat from 2001 onward in terms of where that red line is. And again, here, I don't even need to put up my own chart. I could just look at yours and say, the manufacturing output was still rising after that red line on your chart. It kept going up and up and up until the global financial crisis. And then, yes, it dropped, recovered somewhat, and then has now been flatlined. And so couldn't, a standard fan of the free market just say, Oren, clearly that red line did not hurt the growth of total U.S. manufacturing output. It was the global financial crisis, and then I would blame the Obama administration and subsequent crazy stuff they put in place since then that seems to really have put the ceiling on the growth and total output from U.S. industry.
I think it obviously, like you said, reading the chart, it's certainly the case that the output effect kind of seems to have lagged the employment effect somewhat. And I think there were a lot of things going on in the early 2000s. One implication of what you just described is, you do see a very high productivity jump suddenly in the early 2000s. To some extent, you'd say, was that a sudden kind of gains from information technology and manufacturing? I'm sure that was some of it. I think it's hard to point to what exactly it was. Another effect is you essentially got a mix shift. If you think about sort of what gets offshored when, the stuff that was sort of cheaper, easier, less capital intensive is typically the stuff you would move first. And so you would expect to see kind of, even as the overall health of the sector starts to decline, productivity in the sector potentially increases a little bit. So
let me just stop, make sure that's an interesting point. So you're saying you've got a bunch of manufacturing workers in the US as of 1999, and obviously they're not all making the same stuff. Some people are really skilled technicians and working on really complex equipment, things that are very expensive. They're like, just look at their hourly pay, for example, and other people are making cheaper products or whatever. You don't need to be as skilled to be a worker in that sector. And so clearly when the outsourcing kicks, or it might not, outsourcing's misleading, it might not be US firms. When the imports start replacing US made products, clearly in the beginning, it's going to be the lower skilled US workers who are shifting elsewhere. And so in terms of the average productivity of a given U.S. manufacturing worker would go up just for that reason alone, not because all of a sudden they got more training or something, just because the less skilled people are falling out of the mix. And so the average productivity of the remainder goes up. Okay.
Right. So that's one possible fact. Now, that doesn't explain the fact that the overall output line is still increasing for a while.
Mhm.
And so I think, it's really interesting. There are some very good analyses that also kind of decompose within the manufacturing and say, okay, well, what was actually going up? What sort of fell off fastest? A fascinating, like if we really want to get wonky, a fascinating element of what's going on here is that the way that the economic statistics agencies measure output in the electronics sector is if you put twice as many transistors on a chip, that counts as twice as much output. And so, there's a way in which I guess that's true, even though it's not. There are limits to looking at it that way. And so one really interesting view is if you disaggregate out, if you put aside the kind of semiconductors and look at just everything else, you see sort of a much more distinctive decline in output. And obviously the early 2000s was a time when that was spiking. So I think on all of these things, I always try to emphasize none of it is as simple as, this one simple trick that explains everything.
Right.
Another really interesting way of looking at things is to look particularly at advanced technology products, which if you think about like what was the theory of how free trade should have worked, it's like, oh, well, the cheap, simple stuff goes abroad. We get to specialize in the advanced stuff. What you see is a very steady decline in the trade balance of advanced technology products from a very large surplus all the way back in 1991 at the end of the Cold War, straight through this period and into 2020, where we now have a massive deficit. And so I think we're seeing the sort of aggregation of all sorts of factors. I would also say I totally agree with your point about kind of, post-financial crisis. I think a lot of what's been going on in financial markets and where capital has been flowing is potentially an issue. The regulatory side is absolutely an issue. And so, one thing I always emphasize is no one, or at least certainly I am not saying like everything that has gone wrong is trade, nor am I saying we fix all of this with a tariff. But again, from the kind of like, let's start from common facts, I think it's important to recognize that this is a piece of the story. And if we do see this picture as one that worries us, then we do have to think seriously about what our trade policy has wrought and whether it is the right one.
Okay, great. Let me shift gears a little bit. So I tweeted something out recently and just the reaction was interesting to me. So I just want to run it by you. So I said something like, folks, I mean this sincerely, that I'm not trolling. I just want to know if you support Trump's tariff regime, how would you respond to this thought experiment? I said, imagine there's a guy in your city, this farmer, who's very self-sufficient. He grows his own food. His family members, they make their own clothing and things like that. They do sell their eggs and the milk from the cows and whatever and get money. But what they do with the money, they never use it to buy things from other people in the city, like in terms of, their services or their products. They periodically, they take some of the cash and just, put it in a safe in their basement. But any money that they do spend, it's only to, like they might put some in the local bank. They might buy some stocks. They might buy some property, like rental properties and thing, but they never buy stuff from people whether services or goods from people in the city. And that's how they run their lives. And that's what they do. And I said, would that alarm you in any sense? Would you run to the mayor and say, hey, we need to do something because there's this farmer over here who just keeps selling us stuff, but not really buying stuff from us, and then uses the earnings to invest and to, give loans to people who want to go buy a car or something, or if you need a mortgage, this guy will lend you the money, but he won't ever hire you to do something. So that was my thoughts and then typically, so I had some of my libertarian people saying, yeah, that's great, guy's awesome. But some of the people who did say, right, I am against, or I am for Trump's tariffs, but you're right, this particular guy wouldn't bother me per se. But the reasoning was always, well, because he's probably just a little guy. They said if he now took over and he was, a big portion of the community and he was hostile and had this ideology, and if he had slave labor, and so they kept adding more and more reasons to make it more analogous to China, and then said, yeah, at that point I would want to, but see how, that's reasonable for me, Bob, in terms of, so all that's to say, it looked like it wasn't a trade deficit with a given country per se that was the issue. It was all the other stuff that people associate with China. So I say, number one, do you largely agree with the way they were handling my, pointed question? And then two, if that's the case, then, Trump's recent, Liberation Day and all that stuff, isn't that kind of missing the mark? Like, is it a trade deficit with another country per se that's the issue, or is it a trade deficit with a hostile regime that wants to do us harm and is doing all kinds of stuff that's nefarious?
Well, I think there's two elements to this. I think and you sort of touched on both of them in elaborating on the response. One is the scale point, and two is the sort of nefarious point. And China is obviously both, right? China sort of has the scale and is an adversary. And so I think rightly is kind of at the top of the list as a problem unto itself. I do think it's important and instructive, though, to kind of put the nefariousness to the side for a moment for purposes of the economic discussion. And imagine that China gets a little messier if we say they're just a market democracy. But, look, think of them more like Saudi Arabia or something, right? Maybe we're even selling them weapons. We don't see them as an actual geopolitical adversary, but they are a country with these sorts of economic policies and creating these economic effects. And so if you have that, then what you see is, yes, China is the largest single distortion, but other countries like Japan and Germany, to a very significant extent, also run explicit economic policies that are designed to do what you were just describing the farmer is doing, which is to produce a lot more than they consume and grow their economies by selling into the US economy. And so I think one side of this that economists always emphasize is like, well, consumption is great. If people want to sell us more stuff and not even, make us give them anything back, well, that's a big win. I think it's important to recognize, first of all, that consumption is good, but it is not the only thing for which we have an economy or want markets to deliver. We do have to ask about, okay, well, what are the productive opportunities we are getting or losing? And then I also think we have to take a look at the form that savings takes. Because if, in the example where they're literally just sticking the money under their mattress, that would be very different than what you actually see going on, which is that, the savings returns to the US economy in the form of acquiring American assets, or in a lot of cases, just, one form of asset, acquiring American debt. And so in a sense, to extend your example, okay, well, let's say what the farmer is really doing is they decide to just go around handing out credit cards to everybody, saying, here you go, please just, buy all this stuff from us with this credit card. You don't actually have to pay us right now. We would just like to write down on, you are just committing to paying us this much more over time. And let's kind of expand that farm to be essentially large enough to supply all the food for the region. And so now you have this one entity that is being aggressively subsidized by foreign governments to go around and supply all the food on credit to the people in the city. And so all of the other farms lose all of their business and have to shut down. And all of the people gets lots of food in return for which they commit to some higher share of their future prosperity going to this one entity. Again, there are pros and cons to this. Like, yeah, there would be a lot of cheap food, but as a sort of healthy macroeconomic foundation for the community, especially now when you shift and say, oh, well, we're not just talking about farming, we're talking about industry. So we're talking about the community's ability not just to have good jobs, but also to really be innovative and scale in new industries, to be able to, have resilience and national security. Because let's also keep in mind that whether it's a farm or a factory isn't in the community, right? It's overseas. It's just sending all the stuff in on a ship. And so when you get that equation, even if it's not a hostile adversary in the way that China is, I would say that it's still a very undesirable and unhealthy arrangement for the community that we're talking about.
Okay. And I totally get that. Again, the point here, folks, is not for me to debate, Oren. I just want to tease this out. So let me ask you another one that you prompted there. Because for people familiar with it, Frederick Bastiat has a famous essay, The Petition of the Candle Makers, where it's satirical. He's trying to illustrate the fallacies of protectionism, and he's got the French candle makers go to the government and say, hey, we got this unfair competition from the sun. If we could just pass a law requiring all the businesses and houses that, shutter their windows during the day to keep out the sunlight, look at how much they would boost sales and employment in the candle making industry. And obviously that's goofy, right? Because the sun's giving you the light for free. Why? So that's inspiring me to ask this fanciful thing. And not that this is realistic, but just to make sure I get your perspective. Or suppose, riffing off of the example we just went through, where you're saying, well, yeah, but if there was this farmer who gained such market share, and especially he was advancing the stuff on credit and charged rock bottom prices such that the other farmers in the community, the independent ones, couldn't compete. And after a while, the community's utterly dependent on this guy selling them food basically for free. And you can see why that would be dangerous. But suppose there's manna from heaven and just, they don't know exactly what's causing it, but food just keeps appearing. And and people just go up and grab it for free, like literally for free. And how can the farmers compete with that? They can't sell the food and so the farmers kind of go out of business because everyone's just getting their food. Should the government pass a law like making it illegal to grab the free manna because, hey, this is crippling our ability to make our own food? And what if that just stops unexpectedly down the road and we're in a precarious position? Or would you think it would make sense? Well, let's, we could have stockpiles and we could have farmers ready to jump into action in case the manna turns off. But while we're getting food for free, why not take advantage of it?
I think it's a fascinating hypothetical, and like you could really do a class in a master's in public policy course about exactly this, because it raises a lot of interesting questions. One is, well, how would you want to manage the transition costs? This is sort of an unprecedented disruption that is not of the kind that arrives through technological innovation and process innovation and so forth as a matter of course in a capitalist economy. So what sorts of measures would you want to have in place to measure to manage that transition in a way that addresses the many costs that come with disruption? Then there's this question, fascinating one of like, well, what if you really don't know where it's coming from? Like, how do you manage that risk? I think you're exactly right that if you literally did not know where this was coming from and why, the idea that you would just say, well, all right, that's it. Let's abandon our capacity to produce food would be insane. Even though at the same time, it would be very difficult to justify the costs of maintaining, massive amounts of spare agricultural capacity indefinitely, right? And so, love the hypothetical as a question of how you manage trade-offs in this crazy situation that has never occurred and will probably never occur. That being said, I don't think it actually has much to do with the situation that we are facing in this country right now.
And for the people watching, like, what the heck? Again, the point of that was just to isolate what's causing what. So that with the issue, with other countries, if it was more dispersed, that we thought, no, we got supply chains. Is it so much they're selling below the cost of what U.S. manufacturing enterprises can compete with? Or is it more that, no, it's the uncertainty and that they could turn it off? Because those are two separate things. That's just what I was trying to, tease out there.
Well, and there's another element that, and it's interesting kind of thinking about the manna example, because we're sort of back in the agricultural world, right? Mm-hmm. Like, as opposed to if we imagine, what if all of the industrial goods that you might want just appeared magically all over the place. Mm-hmm. And there, even if you said, well, we think that would happen indefinitely, I think you would have a really interesting question of, okay, well, but then where is the, in a sense, innovation and progress going to come from? Mm-hmm. I think you'd actually have a real concern that if you just said, well, okay, we don't need an industrial economy, we don't need to train engineers anymore, that would probably be a catastrophe for the trajectory of the economy, for economic growth, even as you didn't really need those engineers for today's production. And so then you'd have a very different question of, okay, well, what are the economics of new innovation? Can you actually maintain a healthy pipeline of engineering talent, of sort of developing the next thing, if you're not already doing the work of maintaining the supply chains and industrial base? And so again, like I said, these are sort of fascinating hypothetical questions, but in the world we actually have, I think the harms that we are facing are kind of quite concrete and can be taken on their own terms.
Okay, great. So let's now switch to, you got into hot water, Oren. You were a naughty boy. Somebody, was it was it AEI? I'm referring to.
Yeah, AEI.
So they had, okay, so let me, and obviously correct me, Corin, if you think I'm getting this chronology wrong. So the so-called Liberation Day, the Trump administration announces the schedule of ostensibly retaliatory or reciprocal tariffs divided by 2 that are based, and people were looking into it and said, wait a minute, this is not that experts went to each country and looked at their trade policies and then quantified. We're just kind of taking our trade deficit with them as a share of the trade or the imports and cutting it in half. And that's where we're coming up with the so-called reciprocal tariffs. And so in response, some people at AEI fired out a thing saying, among other things, that the U.S.'s bilateral trade deficit with a given country is caused by many factors, including comparative advantage. And so they were recoiling from this idea that, if the U.S. imports more from a country than it exports to it, that's prima facie evidence that country must be doing something nefarious. That's just natural comparative advantage. There you go. And so then you responded to that. You retweeted what they said, and your comment was, you're quoting them. This is a quote from their report. The trade deficit with a given country is not determined only by tariffs and non-tariff trade barriers, but also by comparative advantage. So that's the quote you had from them. And then you said, can a simple caveman lawyer get some help here? How would comparative advantage determine a trade deficit? So for that, people just were guffawing and said, Oren Cass admits he literally doesn't know the first thing about international trade. How can you not know, Oren, that comparative advantage is the essence of international trade analysis, and that's where trade deficits come from? Okay. And so anyway, I knew that you obviously knew what they meant and that you were asking something more subtle. So why don't I just stop there and then give you an opportunity to explain that, your IQ is above 60. You have studied this stuff. So can you elaborate on what did you mean when you said, why would comparative advantage determine trade deficits?
Yeah, I think it's a really interesting question. And one thing I wonder is, I don't know how much of the confusion I created was because I ellipsed out all of the other things they listed, right? Mm-hmm. So the way that I left the quote, it looked like the only two things that could explain it were nefarious policy or comparative advantage. They had a list of all sorts of other factors as well, all of which strike me as perfectly reasonable reasons you might have a bilateral trade deficit. And as I'd just written very shortly before this, there are absolutely plenty of natural reasons you would have bilateral trade deficits. Those aren't themselves the concern. And, in this conversation so far, a bilateral deficit hasn't necessarily been the concern. That being said, I was struck by the sort of casual inclusion of comparative advantage in the list of reasons you would have a bilateral deficit, because if you think about, it's like start with Econ 101 and when they teach you comparative advantage, or in the Ricardo example where, you've got England makes cloth and Portugal makes wine. And regardless of who is absolutely more productive in making one or the other, there is mutually beneficial gain from specialization. But those analyses, and they very explicitly say this in, Ricardo and Mill make this point, that their analysis specifically assumes that the exchange is of one good for the other. That is, the basic model does not allow for a deficit, because the way that you show that, of course, you have mutually beneficial exchange is to show that each is exchanging one part of its produce for a part of the produce of the other.
Okay, can I stop you for 1 second?
Yes.
And folks, let me just chime in. The reason this fascinated me is because I emailed Oren when this thing went down, and I got a bunch of people that I've co-authored stuff with, and so we're just going around running victory labs like, we told you this Oren Cass clown, he doesn't even know. And I emailed Oren and I was saying, because you're right, I know what they mean. They're just very quickly, casually thinking through like a three-way exchange where, it kind of like the cobbler wants bacon, but the farmer doesn't want his shoes repaired. So you got to have like three people, and they each, trade with the other guy, and a kind of like a cyclical thing where the goods move around in a circle. And that's how but even there, in terms of, maybe the U.S. sells stuff to one country, but the U.S. doesn't want to import from them. They want to do it. You have a 3-country thing. Still, even though you would not have an overall trade deficit, right? So like there was no way I could come up with in the standard story that, as Oren's saying, it's ultimately goods are trading for goods, and it's just a matter of where does it make sense to who you're going to sell to. But it's not that you're going to have countries that have overall trade deficits. And so anyway, I'll stop there, but go ahead. I just want to say,
right.
I realized, the way I thought in 2 seconds, of course I know what the AI people mean. I had never actually thought through that, because you're always just doing 2-country examples in a blackboard.
Right. And so I think that 2-country versus 3-country is interesting, because if it is truly a 2-country sort of closed 2-country economy, then it gets very confusing when you start introducing deficits. Mm-hmm. If you go up to the 3-country and say, well, look, you can have the sort of triangular trade, right? So you'd have bilateral deficits, even though overall balance for each country. There, I think the interesting question is, what explanatory power does the comparative advantage actually have? Because if you actually think about sort of how we define comparative advantage, I think it's helpfully sort of defined in terms of opportunity cost. You still, at the end of the day, as in the word compare, it has to be a function of comparing to the productivity of somebody else. And so if you end up with bilateral deficits, it seems to me that the right way to understand it is that the comparative advantage determines the mix of what you produce. But the actual levels that you then are selling to somebody else are a function of other factors. They're a function of who has more or less demand at various prices for one thing or another. And I think the obvious example that makes sense to me is you can say, okay, well, we know what every country's comparative advantage is based on pick your set of factors that define comparative advantage. Great. Now tell me what the bilateral balances are going to be. And you can't, because the comparative advantage doesn't give you that information. You would then need to know, okay, well, but who actually wants what from whom? And if who wants what changes, those balances would change without any change in the comparative advantage at all. And so I don't know, we'd sort of been discussing, which I know we should do a podcast about it. I am curious kind of how you think about that piece of it as well. It may be a somewhat pedantic point at the end of the day, but to me, it really spoke to the way that we sort of casually say, oh, this is how it's supposed to work because comparative advantage, when in the modern global trading system, comparative advantage just is not doing as much of the work as I think maybe economists wish it were.
Right. And at the best I could say is it's just shorthand, and they mean a bunch of other stuff too. Because like you said, it's just thinking of the standard comparative advantage analyses we go through. They are two countries, like the ones I would do when I was teaching undergrad. It's the US and Mexico, and it was like, what did I do? I think I did aircraft engines DVDs or something, just a real stylized examples. And the US worker can make more aircraft engines and more DVDs per hour of labor than the Mexican worker can, but still, the US specializes in aircraft and the Mexicans in DVDs, and then the Americans and Mexicans get more of both goods per capita. Oh, this is great. But nowhere in my analysis did I have consumer preferences. Like, well, what if after a certain number of DVD, no one wants more DVD, or, you only need so many aircraft engines. So like you're saying, I realized in going back and forth with you over email that you were saying, well, surely the consumer preferences have something to do with it, and that might affect trade flows, right? And it's not merely a matter of the engineering trade-offs and production possibilities frontiers, to use, the jargon. So you're right. I realized that there's all that element. And then also too, like we're saying, even on its own terms, the trilateral or the triangular trade stuff in a static setting would just explain bilateral trade deficits, but it wouldn't explain why one country would have an overall trade deficit with the other two people at the same time. And there you'd have to bring in time at the very least and just talk about, life cycle analyses. And anyway, it gets really complicated really fast. And I don't think we're going to solve it here, but the very modest point I wanted to show is that you had a lot going on when you tweeted that, and it was way more difficult of a question than the people who just thought, don't you understand that the Americans specialize in aircraft and the Mexicans in DVD production? Who doesn't see that? Don't you know how to divide? So I suppose just on that point, then, why don't we kind of wrap up this way? So you mentioned earlier, hey, I'm not saying tariffs solve all this stuff, but were you number one, happy about the so-called Liberation Day? And then can you just speak a bit to what's the best case scenario for you? Like, is that merely just to get them to back down and to reduce their tariffs? Or even if they don't, still that's good because that's going to disrupt supply chains and make the U.S. more resilient in the case of, another COVID kind of shock, that sort of thing?
Yeah, I guess I see the Liberation Day policy in kind of three tranches. I think there's this kind of global 10% tariff, which is something that I'm very supportive of because I think it essentially puts a thumb on the scale for domestic production over imports. And if you could, if there is a future world and when we get back to balanced trade and so forth, then great, you wouldn't need that. But I think in the world as we see it operating, We haven't talked about the capital account at all and the role of the dollar as the reserve currency and so forth. That'll have to be a separate podcast. But
incidentally, that was in my analogy. That's the farmer putting the $100 bills in the safe. That's how the rest of the world could accumulate dollar balances. Yeah, go ahead.
So, that I think essentially a counter pressure that rewards domestic production is very worthwhile. And that also gets into this, we keep punting on the part of the debate, okay, but should we care about manufacturing? Mm-hmm. And of course, if after all of this we say like, okay, but who cares? Well, then, you wouldn't, and the tariffs don't make any sense. If we do care about domestic manufacturing and the health of the industrial base, then I think that kind of global tariff can be an important piece of the puzzle. The second piece is China. And that's where, initially it was a reciprocal tariff with China. Now we've sort of escalated into this much larger trade war. I don't think tit for tat, 100% plus tariffs are the right way to approach it, but I would like to see us quite aggressively push forward with just decoupling from China, with saying there is no such thing as a free market and free trade between systems as different as our systems. I think the legislation in Congress right now, which would revoke that permanent normal trade relations that we were talking about from back in 2000 and establish a very clear schedule of increasing tariffs so that everybody understands over the next 5 years, we are going to get to tariff levels that really make it pretty unsustainable to have substantial levels of trade, would be a good thing, would foster an important transition. And then there's also a lot else you have to do there on, investment flows and so forth when it comes to China. And then the third piece is these sort of reciprocal tariffs with the rest of the world, where the administration has paused them for now and they're pursuing negotiation. And I think the negotiating approach is the right one. I do think the idea of saying, look, there's some backstop to these negotiations, the old kind of liberal world order where the US just presides over an open market, regardless of how everybody else behaves, is over and should be over. But what I see the administration doing is essentially saying, if we can start from everybody understanding that's over, there's actually a new equilibrium that would be quite beneficial, certainly to the United States, but I also think quite reasonable for our allies as well, which says, there's going to be a China-oriented sphere over there. And if you want to be there, be our guest. But here in the market democracy, US-centered sphere, we do have to have some rules if this is going to be a healthy and strong economic and security alliance. We do have to commit, and talk about a Japan or a Germany or a Korea here, we have to commit to more balanced trade, to not being that farmer that just sells stuff and then either, issues credit cards or stuffs the dollars in a mattress. We do need to commit to an economic model that says, yes, high levels of trade are great, but that needs to be actual trade, exports and imports. I think we see in countries like Germany and Japan, they've somewhat run out the string on what they can get out of these sort of very high savings levels, very high export-led growth. And so I think there's an agreement to be reached there. We do need these countries to take much more responsibility for their own security and for deterrence in their regions. And I think that's a very reasonable ask. We certainly do more than our share there. And then the last piece is, for any of this to work, everybody has to agree to hold hands on the China thing. We can't say we're decoupling from China, but Mexico is still a close trading partner with China and gets to be a close trading partner with us. There's going to have to be a you're in or you're out. And so I think that's what the administration is moving toward. And I think if it can strike reasonable deals with our core allies that set up that framework, if we then have the high tariffs on China over time, and if we have some basic tariff oriented toward rebalancing, I think that would be a very positive thing for the U.S. economy.
Okay, great. And you anticipate, I was going to ask you with the China thing that, what wouldn't they just sell, the stuff they're exporting to the U.S. right now, couldn't they just send it to some other country, Luxembourg or something, and they slap a new label on it and then, we're happy to import from Luxembourg, that's fine. And so you would include to say, if we catch, kind of like if we have sanctions on some country, we can kind of see, well, wait a minute, but these guys over here are dealing with them. And so then.
And I think, by the way, it's important to your point about like Luxembourg, like I think a lot of people were making fun of like, why do you need reciprocal tariffs on Madagascar, right? Madagascar just sells us vanilla. Like, who cares? And in one sense, that's absolutely right. The problem is if you tried to just do this with major countries and say, well, Madagascar can do whatever it wants, you'd pretty soon have like an awful lot of industrial goods with made in Madagascar labels on them. And so, I don't think the final settlement with every smaller country is the kind of agreement we're talking about here with a Japan or an India. But I think even there is going to have to be a basic, look, if you want to be in this trading block, you're going to have to hold hands with us on China. If you're not willing to do that, then you're out because because that is a reality of the bipolar world we're moving toward.
Okay, great. And that's good. I do see how your worldview and policy recommendations do have a inner consistency to them that, you can't just have gaping holes because otherwise, somebody would just slap a new label on it and say, yep, Madagascar product right here. Okay, well, folks, my guest has been Oren Cass, the founder and chief economist of American Compass. Oren, for people who were intrigued by your remarks, is there some go-to resource you want to point them to?
Well, as you've noted, we're always doing stuff on Twitter at Oren_Cass. And I also write a couple times a week a Substack called Understanding America. That is where a lot of this is being discussed in more depth.
Okay, great. So, Oren, thanks so much for your time and insights. I think the listeners would have gotten a lot out of this.
No, this was fantastic. Thank you. Really appreciate it.
And thanks, folks, for tuning in. We'll see you next time.